Buying a home is a significant investment, and making mistakes during the mortgage process can cost you thousands of dollars over the life of your loan. For most people, buying a home is the largest financial decision they'll make in their lifetimes. It's not a deal easily undone once the final papers are signed, so it makes sense to understand the ins and outs of mortgages before taking the leap into homeownership. Here are 6 mortgage mistakes to avoid and what to do instead. So in this video, we are going to discuss about 6 mortgage mistakes could cost you thousands. The video is going to be amazing. Make sure to stick till the end. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. Number 6. Accepting added fees. A loan origination fee is a percentage of the loan amount charged by the lender to cover processing costs. It's usually paid upfront at closing. Compare offers to negotiate or find a no-fee loan. A loan application fee is a non-refundable charge by a lender to cover the cost of reviewing a loan application. The amount varies by lender and loan type. Lenders charge application fees to cover the costs of processing your loan application. These costs include things like the time spent by loan officers reviewing your application, the cost of running a credit check, and the cost of appraisals or other documentation. Before you apply for a loan, be sure to ask about the application fee. This fee may be one of the factors that you consider when choosing a lender. Broker fee is charged by the lender to the real estate agent who helped you find the property. Underwriting fee is charged by the lender to cover the costs of evaluating your loan application. Sign-up fee is charged by the lender to cover the costs of setting up your loan account. The document preparation fee is a charge that is levied by the title company to cover the costs of preparing the documents that are necessary to close your loan. These documents can include the mortgage, deed of trust, and any other paperwork that is required by the lender or the state in which you are purchasing the property. The amount of the document preparation fee will vary depending on the title company and the complexity of the transaction. However, it is typically a few $100s. The document preparation fee is one of the closing costs that you will be responsible for paying when you purchase a home. Other closing costs can include appraisal fees, title insurance, and origination fees. It is important to be aware of all of the closing costs that you will be responsible for so that you can budget accordingly. Number 5. Paying full price for commission. Another mortgage mistake is paying full price commission to a real estate agent. The average commission rate is about 5.49% of the sale price, which can deduct thousands from your potential profits. But commission rates aren't standardized or set in stone. You can negotiate for lower rates. Work with a low-commission real estate company that negotiates with agents to procure a full range of services for a fraction of the traditional price. You'll still get an opportunity to ask your realtor questions and choose the one who's best for you. The only difference is you'll pay less for their services in the end. Number 4. Buying too much house. It can be exciting to see how much you're approved for, but one of the biggest mortgage mistakes is shopping for a house that hits the top of your budget. Many new home buyers don't realize that what they pay toward principal and interest is just half of their monthly mortgage payment. They fail to recognize that property taxes, homeowners insurance, and sometimes mortgage insurance are also included. Unexpected expenses can be hard to meet when you borrow up to your limit. Your total mortgage payment shouldn't be more than 28% of your monthly pre-tax income. If you make $100,000 a year before taxes, just over $8,000 a month, your mortgage payment should be roughly $2,300. Ask your mortgage lender about the best budget for you. Number 3. Choosing the first bank that approves you. Choosing the first bank that approves you for a mortgage is not always the best option. It is important to shop around and compare offers from different lenders to find the best deal. In a rush to get pre-approved, you might decide to go with the first bank that says yes, but the rate could be higher than other banks or mortgage providers. Credit unions, smaller banks, and online mortgage lenders can have dramatically different rates and fees. It is important to take the time to research and compare different mortgage lenders before choosing the first one that approves you. This is because the interest rates and fees can vary significantly from lender to lender. By taking the time to compare different lenders, you can save yourself a significant amount of money on your mortgage over the long term. Get pre-approved for a mortgage. This will give you an idea of how much you can afford to borrow and will help you compare lenders more easily. To get pre-approved, you will need to provide the lender with information about your income, assets, and debts. The lender will then use this information to calculate your debt-to-income ratio and credit score. These factors will determine how much money you can borrow and what your interest rate will be. Shop around for the best interest rate. Interest rates can vary depending on the lender, the type of loan, and your credit score. It is important to shop around and compare interest rates from multiple lenders before you choose one. You can use a mortgage calculator to estimate your monthly payment based on different interest rates. Number 2. Not getting pre-approved. Picture this. You find the home of your dreams and it's within your budget. Turns out it's also the home of someone else's dreams. In a tight market, making an offer loaded with contingencies, such as mortgage approval, isn't likely to make you successful. Getting pre-approved for a mortgage is a great way to show sellers that you are serious about buying their home. It also gives you an idea of how much you can afford to spend, which can help you narrow down your search. If you are a veteran, you may be eligible for a VA loan, which offers special benefits and lower interest rates. Be sure to check with the Veterans Affairs Office to see if you qualify. Getting pre-approved for a mortgage can help you in many ways. It can help you negotiate a better price on the home because the seller will know that you are serious about buying and that you have the financial means to do so. It can give you peace of mind knowing that you are financially prepared to buy a home because you will have already been approved for a loan. This can speed up the home buying process because you will not have to wait for your loan to be approved after you have found a home that you want to buy. It can help you avoid any surprises when it comes to closing costs because you will know exactly how much money you will need to close on the home. Number 1. Draining cash reserves for a down payment. Home buyers typically put down 20% of a home's purchase price to eliminate mortgage insurance and keep monthly payments low. But draining every bit of cash from your savings is a big mistake, especially when there are additional home buying costs, including a home inspection is a visual examination of the condition of a home. It is typically performed by a licensed home inspector who will look for any potential problems with the home's structure, systems, and appliances. The home inspection report will detail any problems found, and the buyer can then decide whether to negotiate with the seller to have the problems fixed before closing on the home. Closing costs are fees and expenses associated with the purchase of a home. They typically include things like title insurance, appraisal fees, and loan origination fees. The buyer and seller will usually split the cost of closing costs, but the exact amount and who pays for what can vary depending on the state and the type of loan. Home insurance is a type of insurance that protects homeowners from financial losses caused by damage to their home or belongings. Homeowners insurance typically covers things like fire, theft, and water damage. It is important to have home insurance in place before you buy a home, as most lenders will require it. Add all of the expected costs of buying a home, then calculate the down payment percentage you can afford. Don't forget to account for major purchases, such as furniture or appliances, you might need to make immediately. You can always make an extra mortgage payment or add to the principal each month, but starting out with no cash on hand is a major mortgage mistake. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.